Good afternoon, everyone. My name is Thilan Wickramasinghe. I'm the head of research for MIBG in Singapore. And welcome to our session. I mean, the markets have been a roller coaster so far this year, and the hits keep coming with inflation, war, interest rates. So we are here to discuss how these are going to impact Singapore in the second half. And what sort of strategy we should adopt in terms of, especially in terms of stock picks. To do that, we have Hak Bin as well, who will be taking us through the macro session.
Great. So I'll kick off first on the macro, probably 20 minutes or so. It's a relatively big pack. I won't run through all the slides, but yeah, we're happy to share the slides if you're interested. I think my title for Singapore economy is the bottleneck. It's a bit constrained, particularly manpower, and that's been partly responsible for the high inflation pressures, the high wage cost pressures. And I think that's probably still going to persist in the second. War between this tailwind, which is coming from reopening, which is helping to boost the laggard sectors. But we've got this global headwinds from the war, from the aggressive Fed rate hikes and rising energy prices. So which one's going to win? And our sense is that in the first half, reopening was probably a bit more powerful. But as that those winds kind of dissipate in the second half, we think the global headwinds is going to dominate. 2.8% is below the government's 3 to 5%. I think on vaccine rollout, that's fine. That's processing, and we just have to watch out for the subvariants of the Omicron virus. Inflation, inflation is top of mind for the MAS and for the government. It's risen dramatically, and we saw this surprise off-cycle move again from the MAS to recenter the band, essentially the fourth tightening move. Peak in the third quarter. Coming off, if you look at the UN Food Price Index for 4 months now, and of course, we're starting to hear news of it as well as the palm $3, which are good news. Still, we're a bit worried about the wage side because come September, the government will be introducing their version of the de facto minimum wage called the local qualifying salary, and also expand the progressive wage model to affect about 30,000 workers.
Ben, could I just get in here that your audio keeps breaking up? Do you mind just switching off your video and then?
Oh, okay. My video, the slides are blocked, Okay, I'll try to speak a bit louder. And then the labor market essentially is still pretty tight. We are seeing foreign employment coming back. But of course, resident employment is already about 4% above pre-pandemic levels. So we don't have this problem with a low labor participation rate that you're seeing in the US or the UK. And forecasts, and I think 0.8% this year, 1.5% next year, and we're actually looking for second half, somewhat closer. I think some key points is summarized on top of the slide. The Fed is, been pretty aggressive. I don't think we've seen this kind of interest rate shock for quite some time. So I think that's gonna, be a big shock and climb to roughly about 4% by the end of this year. And I don't think Singapore has seen this kind of interest rates for almost 20 years. It will probably continue rising next year to about 4.5%. Squeeze out of consumer interest rates going up from 2% to 4%, say for mortgage rate. I think you will find generally it will go up probably about 25%. Okay. Oh, okay. Is that better?
Yeah, let's go with this.
Okay. The yield curve inversion. The yield curve has inverted or close to inversion for the 10-year, 2-year. That's something that Bloomberg emphasizes. I think the more reliable recession indicator is actually the 3-month 10-year. And for that, you're looking at a red line. And for that, it's still positive. So the Fed is hiking, but I think the threat of recession will only materialize something like 12 months later if the Fed does move the rates closer to where the bond yields are currently. So our rough rule is that probably the Fed funds rate does cross about 3.5%. I think a US recession is likely. I think that the 10-year 3-month will turn negative, and probably I think Singapore may be pulled into the recession as a result. This is a model that's actually put out from the Federal Reserve from the New York office side. So I think we just replicated their model, and it's easy. You can just go to the website. It's updated every month. And based on May numbers, based on the 3-month 10-year, it's still only about 4% 12 months forward. And that's because the Fed is only slowly hiking the rates, and therefore the recession is probability will go up next year, but it's still some way in the future. When you replicate the same model we do for Singapore, we get a recession probability closer to about 6%. Still the kind of markets have. The Sing-Nier has moved up and strengthened quite a bit, and you can see that the recentering that happened on the 14th July, just a week ago, roughly was about 1.5% by estimate above the midpoint. So they've done four moves, and it's currently trading around 0.7% above the midpoint. So I think generally we expect the Sing dollar to continue appreciation on trade-weighted basket, and our FX strategist is looking for the Sing dollar to appreciate even in absolute terms by the end of the year into next year against the US dollar. People mobility recovering, but I gotta say that when you look at the actual Google numbers, it's not as strong as some of the other ASEAN countries, which have gone above the pre-pandemic levels. And I think you get a sense of it when you go to Raffles Place, right? Not everybody has gone back to the office. A lot of companies have work from home arrangements, but it is improving, and that should push some of the sectors that's been lagging behind. Generally, on a GDP real level, when you compare it across ASEAN, Singapore, the dotted line is above and has recovered a lot more sharply than the other countries. On this chart here, Malaysia has been sort of lagging behind, as well as Thailand. Second quarter GDP is still decent, 4.8%, but on a Q-on-Q basis, it was essentially zero, seasonally adjusted. So I think there is some moderation, especially on the trade-related services side. And construction is recovering a bit more slowly than expected, considering it's almost like still 25% below pre-pandemic levels. We are expecting a sharp slowdown in the second half, as warned by from MTI. I think when you look at the data, I think also we're just going to highlight that, like industrial production, the red line seems to be pretty decent, but bear in mind that it's almost exclusively driven by semiconductors, which is a pretty big share of IP, almost a third now. And when you strip out semiconductors, which is the gray line, it's actually contracting. Similar, when we report nominal exports here, right, it's in value terms, and of course that's been flattered by higher selling prices. When you look at the real Nordex, more the volumes, actually real Nordex, actually with the data that just came out, has been contracting now for 5 months, which shows the impact, I think, of slowing global growth on exports. Some of the data on the trade-related side, container throughput has been weakening, fell -1% in the second quarter, did inch up slightly by June. Air cargo, contracted for 3 straight months now in May. Construction recovering, but rather slow. I think all the foreign workers are back, and hopefully this will pick up a lot more strongly with the reopening of borders, and some HDB delays and all that will come into stream hopefully by the end of the year. Fantastic numbers as we're seeing out of Changi Airport. So visitor arrivals are soaring, 544,000 in June alone, but not from the usual like China markets and so on, right? It's coming from Indonesia first, India second, Malaysia third. Bear in mind that even though this is a very sharp increase, that when you compare the pre-pandemic levels, it's still 65% below right? So just to put in perspective, it's still a long way to go. In terms of hotel room occupancy, improving as well, as you can see on the right-hand side chart, 71% as of May, but not quite back yet to pre-pandemic levels, but clearly far better than during the worst during the pandemic of 40% 2 years back. Retail sales are picking up, recovering. The latest number pretty decent, 18%. F&B, surging in May, driven by restaurants and food caterers. It'll be interesting to see whether these numbers hold up, as interest rate increases occur, as whether the millennials are affected by the crypto crash, but also whether the borders have been reopening, and during the June holidays, there's a sense that more Singaporeans are shopping abroad, given how strong the Sing dollar is, and whether that spending abroad is also affecting some of the spending in Singapore as a result. So I won't be surprised if there's some softening, in the retail sales numbers from June, July onwards, with more shopping options, abroad for Singaporeans. Employment has recovered, pretty decent, 42K. We don't have the second quarter yet. It's led by services and construction, so I think that will ease the pressure. But bear in mind that when you look at total employment, we're still not back where we were pre-pandemic. And bear in mind that during the whole pandemic period, there was a drop of almost 200,000 collectively, and a lot of it was from foreigners, right? And foreigners have not come back in a full way. But that should slowly recover. I think the government's also being a lot more selective about who gets to work in Singapore. A survey in the third quarter is still fairly positive. We've seen some, of course, this is about probably 1 month ago. We've seen some US firms' hiring intentions slowing down. But as far as this survey for Singapore is conducted, a lot of tech firms, a lot of finance firms, finance, construction, everybody seems to be expanding their hiring here, in the sense that the manpower shortage is still pretty acute. So it's been pretty dramatic, because when you look at many countries, very few have seen this kind of a strong labor market rebound. And I presume part of the reason was the government's very generous support, particularly the wage subsidies that have also encouraged hiring, but also deterred firing. So the unemployment rate is pretty much back to where it was. But job vacancies to unemployed persons is essentially at a record high. It's 2.4. And that, in some sense, is also could be interpreted as being too tight, a bit unhealthy. And that is probably partly fueled the wage growth increases. So monthly wage earnings, you can see, is surging. I don't know, you probably had a few markets, friends changing jobs and so on. But basically, in the first quarter of this year, average monthly earnings surged by almost 8%. Right? And I think the sense from the government is that wage growth intensity will probably still continue for the rest of the year, but maybe slow down perhaps about 6% still. So that's still pretty high, and therefore that rising manpower cost is probably going to bite into company earnings and so on. You can see the wages that have gone up dramatically, include those of the retail, trade, professional service, Infocom, wholesale, trade, finance. MAS reserves, there's been some strange behavior on part of MAS reserves, but actually when you look at it, since the pandemic started, it's been quite dramatic, because over the last two and a half years, foreign reserves at MAS has actually gone up by roughly about 200 billion US, which is quite dramatic, because you look at the countries in the region, maybe Indonesia has seen a 30 billion increase, Malaysia is flat, and then you see a drop in the data. And that's because now the capital inflows have been so huge that if you don't, if the money was just left at a central bank, the numbers will be close to 450 billion, or maybe even closing into 500 billion. And so there's almost like a monthly transfers now to GIC. So we estimated here from March to June alone, there were 3 consecutive transfers, I think, totaling 173 billion. So it gives you the extent of the capital inflow trying to rush into Singapore. We don't know where the money is coming from, but presumably some are coming from China or Hong Kong or the neighborhood, which is trying to capitalizing on the Singapore strength, perhaps capitalizing on Singapore's safe haven status, and also perhaps that the monetary policy is going to be tight and that will allow for the Sing dollar appreciation. So there's a lot coming to height. As a result, if the MAS had intervened, the Sing dollar would probably even be stronger than where it is today. Inflation, I guess, maybe worth so some cyclical issues coming from commodity shipping, rents are climbing, foreign labor costs, and some structural forces that may be a bit more persistent. And that's the government's plan to introduce a minimum wage, to expand the progressive wage model, but also, tech, I think, is no longer as inflationary. And of course, we will be facing the 2% GST hike next year and the following year. Plus, there'll be higher carbon tax, property tax, and so on. So some of this price pressures will persist. You can see how dramatic the rise in inflation here. When you look at the components, transport is the most obvious, up 15-16% year on year. And we've seen it in the COE premiums. Good news is private transport is outside the core inflation. So that's not something that MS focuses as much on. But food prices, 4.5% is also a big concern. I think the good news is that there are signs that the food price index is starting to cool. Last 4 months, it's come off the peak. So that will take off some of the pressure, from the food price side in the third quarter. We've seen here also in the palm oil prices and also energy prices, right? Energy, oil was 135 at the peak, currently it's about $100. So that's off quite a bit. And that's going to provide some relief to core inflation. And Singapore's core inflation has food and fuel inside. So that, I think I agree with the MAS that it will probably peak in the third quarter and come off. The big question is how fast it comes off. On the transport and some of the supply chain disruptions, some good news as well. Clearly we're still above where it was, but you look at the container freight rates, it is also starting to ease. So maybe the ports have got their things in order, but I suspect also some demand cool down with the global slowdown. And even some disruption to chip prices, right? Chip prices have also slid down from their highs, some 6 months ago, since August actually last year. So I think that also help, reduce some of prices and so on electronic goods. Rents, we're less confident. I think rents is still going up quite dramatically. Here we look at the SRX HDB rental price index. It's up 18% year on year. Condo prices up 21%. Bear in mind the SRX looks at recent volumes, whereas the price index looks at the whole stock of housing rents, right? And that will be slower changing because not everybody changes the contract rentals every month. The rental accommodation cost component within the CPI is roughly about 4%. But generally, I think that's still a risk that basically that's going to be raised, right? But the accommodation cost doesn't go into the core component. Core CPI goes into the headline for the MS. Property sales volume dipping, but prices continue to rise. So it'll be a good question whether this rally will continue, especially with interest rates starting to climb, more dramatically in the coming months. I think worth highlighting as well that during the pandemic, it wasn't just foreigners leaving; it was a lot of Singaporeans coming back, right? So this is the data for overseas Singaporeans. It peaked in 2019 before the pandemic, 217,000, and now it's about 180,000, so roughly about 37,000 Singaporeans came back. I presume most who came back were probably a bit more affluent. They are probably they can buy property. Some may be the first, and also I think that also provides some narrative on why there's been some support as well for residential property prices, especially on the private side. Last few slides just to show also Singapore is benefiting from the zero COVID strategy in China and Hong Kong, and also the national security law. You can see that Hong Kong numbers have been improving, but generally when you look at regional headquarters in Hong Kong, the right-hand side chart, you can see like from Japan, the red line, yellow, the US, from the US, both are coming down. That's been replaced by more headquarters coming from mainland China, which is the gray line. And more firms are planning to leave Hong Kong, full relocation 25%. And I think I don't know where I did here, but I think Singapore does feature, as a place where they could attract more of the headquarters and relocation. I think with that, just leave on this slide. So longer term, we're looking for growth, potential growth, 1.5 to 2.5%. there are demographic challenges why higher potential growth is not really possible, because of the slowing population growth, which is actually in the 0.1, 0.2% citizen growth rate is in that area now. And really, it depends on the immigration policy. But it looks like the tighter foreign manpower policy is here to stay, that the government will be very calibrated in who it lets in, shifting to a point system as well for the employment pass, and it focuses on developing a Singapore core. There's also a broader move to the left, expanding the social safety net. We are introducing the local qualifying salary, the de facto minimum wage, broadening the coverage of the progressive wage model. Retail this year, 30,000, but F&B next year, which covers almost 100,000 workers. There's a higher wealth tax and more inclusive growth. There's generally also more higher taxes, to fund some of its transfers, the healthcare spending, and also the climate infrastructure projects. So higher GST, carbon, property, and wealth taxes. Singapore will, I think, still win and become the Switzerland of Asia, and that it will maintain a strong hub status in finance and tech, MNCs, aviation, private banking, asset management. We also seeing very clear benefit, that Singapore is benefiting also some of the supply chains, I think, to ASEAN. We see that in huge semiconductor investments, but I say in our neighboring countries, as both Malaysia and Indonesia, is seeing a surge in FDI interest as well, and I think that will also benefit Singapore as an intermediary. And of course, China's zero COVID and Hong Kong's loss of independence also favors now in terms of the Hong Kong-China rivalry, favors Singapore. Longer term, there are probably huge investments planned. And pass it over to Thilan. Happy to take questions at the end.
Thanks, Hak Bin. Let me just put my slides up on screen. Okay. So as just following up from Hak Bin, Singapore has been one of the better performing markets. So it's actually held up relatively better than most of the regional ASEAN markets. So that's where I want to kind of start. So Hak Bin's already gone through the macro. So if you look at the left-hand chart here, the main thing that you kind of see is that during times of rising interest rates, Singapore actually tends to outperform global equities. Since 2009, what's happened is the market's kind of lost its relevance in a low interest rate environment where you've seen more and more capital being allocated towards growth as well as more higher growth markets. And you're starting to see that shift coming through again. And that, if you look at the right-hand chart, you see that if you look at Singapore and the SDI in particular, more than 80% of it is value stocks. So these are your banks, industrials. So, profitable, not very high growth, but reasonable valuation companies. So I think that's the general dichotomy, especially as we go into a high interest rate world. So as I said, Singapore's kind of, hasn't moved very much compared to most of the other regional markets. The regional markets have all underperformed, except for maybe Jakarta, JCI in Indonesia, but largely from the commodity cycle. But if you look at Singapore itself, if you look at what sort of sectors have been performing, it's largely again the value sectors, the telcos, the utilities. The sort of outlier here are the financials, which have actually underperformed, and I'll get to why I think that is later on in this presentation. In terms of flows to SGX, we see that institutional investors so far this year have been net buyers compared to net sellers largely in last year. So you're starting to see more and more attention being paid to Singapore. And if you look at where the critical sectors that institutional investors are buying, it is the more value sectors like the telcos, as well as some of the consumer cyclicals as well. Again, what's very, very notable is the banks have had outflows. Within this, we are looking at overall earnings for the market still improving going into this year. As you see, in 2021, you saw a very, very strong rebound, given Singapore was one of the earlier countries to open up. But even over that high base, we're still looking at overall earnings growth coming through this year. Now, what was interesting for me at the end of the first quarter results season, we are now pretty much going into the second quarter results season, but what was interesting for me was there was very little earnings downgrades, despite the fact that companies were already starting to sound a little bit cautious. So I think going into the second quarter, I think there is a risk that you might see bigger downgrades coming through for earnings for Singapore. But for me, even if you have higher downgrades, valuations are still very quite reasonable. So one of the exercises we did was to look at overall all the different sectors that we have, and also look at stress testing all the stocks we have in our coverage. And one of the things and the two sort of variables that we looked at was how easy is it for companies to pass on the higher costs as inflation rises, and also what will be the impact of higher interest rates for most of the sectors. And you can see on the left-hand table, for most of the sectors in Singapore, most companies have the ability to pass on about a third to a half of higher prices on to the consumers. So I think while you will see some downgrades and margin contraction over the next few quarters, I think there is still a certain amount of ability for companies to pass through costs. And also, if you look at from a balance sheet point of view and from an interest rate point of view, we see that even with a sort of a 3% Fed funds rate over the next couple of years, the overall impact to earnings is relatively manageable. And part of that is, if you actually look at the balance sheet composition of Singapore, nearly 43% of listed companies in Singapore have net cash balance sheets. And we've also seen quite a lot of active shifts from floating rate interest rates to fixed rate interest rates across a lot of the corporates, particularly the REITs as well. So I think you will see some margin erosion as interest rates rise, but I think so far there is a certain level of manageability to it. And that's on the shorter term. One of the things that we also looked at on the longer term is that we believe that Singapore as a market will actually increase relevance. The left-hand chart shows you the volumes of deals from M&A to restructuring that is happening in Singapore. We've seen a Temasek-led push for a lot of the GLCs to become a lot more relevant over the past couple of years. We saw that with CapitaLand, we saw that with Sembcorp, Keppel. So a lot of the GLCs, particularly driven by COVID, as well as the sort of mega trends of digitalization, ESG, you're seeing a lot of these companies re-looking at their business models, re-looking at what their core competencies are, and then kind of restructuring their businesses. So that this, we believe, will actually drive the overall relevance of the market going forward. Now, at the same time, one of the biggest changes my team has seen so far this year is a number of clients calling us and asking us for sustainability metrics. So I think more and more investors are starting to look at sustainability as part of their core investment process. Indeed, we are doing a lot more work on things like emissions comparisons, social metrics, things like that, ESG risk scoring. And I think as this trend becomes more and more mainstream, you should start to see Singapore becoming, again, a lot more relevant from a regional point of view. If you look at the overall ASEAN region, as you start to put ESG metrics on top of risk metrics, a lot of companies become stranded. While in Singapore, if you even take the Sustainalytics as ESG scoring, ESG risk scoring, it has one of the lower risk scores. So you should see more and more funds flowing to Singapore from that point on as well. So within all this, market valuations are quite cheap on a PE basis. It's trading even one standard deviation below long-term mean. So which is why I said, even if you start to look at earnings cuts going into the second quarter of this year, and we do expect some cuts to come through, when you look at where PEs are, you still have quite a bit of buffer there. And it's a similar sort of case on the book value as well. And again, I think unlike sort of past cycles like the GFC, where there was a lot of uncertainty around the book values, this time around, given a sort of government support that was in place during the 2020-21 sort of COVID cycle, and as well as going into the current sort of reopening cycle as well, the book values are a lot more clearer than in the past cycles. So within that, what will drive the market higher? Harbin kind of mentioned this in his presentation as well. So I think the market relevance is increasing, particularly with more relocation of North Asian capital coming into Singapore. And secondly, Singapore is one of the most highly vaccinated populations within the region. So even if you have these new COVID waves coming through, it will be a lot, I think the disruption levels will be a lot lower. We are in fact going through another COVID wave at the moment, but we are not really seeing the overall medical systems being particularly stretched as well. And then also homecoming and neutral country listings. I think you're going to see a lot more companies looking for a neutral trading venue, and I think Singapore will provide that within the region, particularly for some of the Chinese ADRs that are looking for new homes. We saw NEO listing in Singapore. We saw recently Philippine distillery also having a second listing in Singapore. So I think recently SGX was guiding for 30-40 new IPOs over the next 5 years annually. This level of guidance we only last heard in the 2000 sort of early 2000s. So again, I think the relevance of the market will increase going forward. So within that, we are still keeping a STI target of 3629, which is about 16% higher than where it is. This is on a 12-month basis. Now, how do we kind of position sectors within this framework? So if you look at how we are kind of looking at all the sectors, generally the value sectors we have a higher preference for than some of the growth sectors. So the banks, despite their performance, we are quite positive on them. We also like the industrials, particularly as a reopening theme, as well as a shift towards a more longer term shift towards sustainability and so on. We also like the telco and media sector. Healthcare from a policy standpoint, as well as land transport. The REITs, we are more neutral at this stage, particularly from the fact that interest rates are continuing to rise. So that's going to tighten the spreads in terms of overall dividend yields. And the tech manufacturing sector, we are slightly more towards the positive side, despite the fact that it has got hammered along with the rest of the global tech sector. And I'll go into a little bit more detail on this now. So for the banks, the way I see it is they have been hit, they've pretty much given up most of their gains that they saw in 2021. And I think largely This has been driven by the expectation of slowing growth, particularly in the region, so loan growth coming off, and also the expectation of asset quality issues as we head into a recession. Now, if you look at the three Singapore banks, and if you look at their net interest income, loan growth only sensitivity only affects about 20% of net interest income. 80% of net interest income is actually driven where margins are going. And this is particularly true since the GFC, as these banks restructured their balance sheets to continue to grow even in a low interest environment. So as the Fed continues to hike, and the transmission of Fed rate hikes to Singapore is fairly consistent, you should start to see a lot more operating leverage coming through for their net interest income. So you should start to see net interest margins seeing expansion going into this year as well as next year. So any sort of while we do expect some slowdown, I think that slowdown will be offset by the stronger net interest margin upside. Now, on the asset quality side, if you look at these banks, they've kind of come through the COVID period with very strong levels of provisions, and asset quality has actually held up, and it's been quite benign, even as companies exited a lot of the moratoriums across the region. Now, if you do see economy slowing down, that asset quality side will start to sour a bit, but provision levels are already close to 100%. And while there was some earlier expectation that you might see some write backs of provisions, I don't think that's going to happen. So the banks will continue to keep provision levels. So even as asset quality falls, they would have significant amount of buffers to face that. And particularly for banks like OCBC and DBS, who actually pay a fixed dividend. And I think there is very limited risk in terms of those dividends being revised downwards. In fact, in the last quarter, DBS was actually guiding for higher dividends as we go through to the rest of the year. So at sort of current levels, you're looking at about 5.5–6% sort of dividend yields with banks. On healthcare, this is also a sector that we are quite positive about in Singapore. Largely, this is being driven by policy, where Singapore's moving from a volume-based, hospital-based healthcare system to a preventative healthcare system, where the GPs, so the local GPs, will take a much bigger role in providing healthcare for the population. So from next year, all Singaporeans have to register with a family doctor, and that will be the first point of contact. And what this means is for groups that are running the larger primary healthcare networks, they will benefit, particularly names like Raffles Med, who have one of the largest primary healthcare networks, will actually benefit from this policy support. And at the same time, on the shorter term, while some of this PCR testing, which are all fairly low margin stuff, go away, the borders reopening, we are expecting a lot more elective procedures, medical tourism to take their place, which are higher margin. And then on industrials, also we are quite positive, particularly on aviation services. We are starting to see more flight volumes taking to the air, more airplanes being brought back to service. All of them will require additional tests. And also we are seeing, given where freight rates are, there is a conversion of passenger to freighter as well. So companies like ST Engineering should benefit from this. And at the same time, the conglos are rapidly restructuring. We've seen that with Sembcorp Industries, Keppel. They're moving more and more towards to a sustainable alternative energy sort of investments, as well as ICT. So they're kind of aiming themselves at the growth sectors, while kind of trying to get rid of some of the more stranded sectors like offshore and marine. As I said, on the REIT side, we are taking a much more stock-specific approach. I think you're going to see some pressure given where interest rates are going. So you will see some yield compression there. But within that, we think that industrial REITs, as well as some of the hospitality REITs, will benefit from the reopening, as well as some of the mega trends like digitalization and so on within the region. The technology manufacturers is a sector we are positive about, particularly on the upstream names. It has been pretty much hammered along with the rest of the tech sector. But if you look at the Singapore's tech manufacturing sector, they are mostly manufacturers who are manufacturing chips. And we are still in the middle of a chip shortage. And if you look at most of their customer segments, they are all guiding for very, very strong demand going into this year as well as next year. So I think a lot of the tech hardware players will benefit from the current cycle. And given where demand is, we do also expect them to be able to pass on the higher costs a lot more easily than in the past cycles. The telcos also, I think, will benefit from two very specific drivers. The first is we are looking at ARPUs actually growing, and I think this will happen partly from 5G. 5G take-up has been a lot better than expected, and also a lot of the MVNOs, which actually drove down a lot of the ARPUs for the telco majors, as they come in to renegotiate their 5G capacity. You should see overall ARPUs increasing for the telco majors. And at the same time, as borders reopen and we start to see a lot more activity in terms of roaming, that should also provide some support as well. And at the same time, we're seeing companies like Singtel, which have significant amount of latent assets, looking to offload that and restructure those assets, as well as refocus their business towards more ICT around the region. These also should drive overall longer term margin and volume growth for the sector. Now, within this, what's our stock picking strategy? So we have a sort of a barbell approach, where what we call the moats plus growth approach. So we like to pick stocks which have very good near-term earning certainty, and also fairly strong competitive moats, which will allow them to have better cost pass-throughs than their peers. So stocks like DBS, OCBC, who will benefit from higher interest rates driving up their net interest margin. Their cost of funding is fairly low. And also, if you do see North Asia reopening, you will have that benefiting these banks as well. We also like SGX, particularly from the commodity volatility that we are seeing across the region, the supply chain volatility, as well as the currency volatilities. Their derivatives business is growing a lot faster than the equities business, and the derivatives business is very well placed to benefit from these trends. And if you actually do see more listings and more capital raisings coming through for SGX, that will be an additional bonus. CDL Hospitality Trust is also another name that we look at, particularly from the ability to benefit from the reopening, particularly in the key markets. Another stock we like is Comfort Delgro. It's got a it's almost at a 5-year low at this stage, but we've seen very strong ridership growth and delivery coming through. And if you really look at their dividend yield, which is around 4.5%, nearly half of that actually come from regulated activities. So that dividend, half of that dividend yield is guaranteed, while the other half is driven by operating leverage. And what we've seen, particularly in Singapore, is that even though you've had taxi prices being increased, demand has been fairly inelastic. So I think as we go through, you'll start to see a strong earnings delivery coming through this stock, which should support its re-rating. Now, on the flip side, we also like stocks that have the potential to accelerate growth, particularly in the medium to long term, because they're geared towards longer term themes like emerging market consumption, policy support, sustainability, and so on. And within that, we like CapitaLand Investments, very asset-light business model with recurring fee income streams. And they've also got a very strong pipeline to grow their funds under management, particularly from CapitaLand's asset. We've also got the ability to actually choose up their funds under management fees with more profitable products as well, particularly with given the exposure that they have to new economy. And our analyst Sutai is actually expecting a second half performance to be quite strong as well. So the balance sheet is pretty strong, fairly decent gearing, and quite a bit of the debt is actually fixed. And then we also like Singtel. Again, from the ARPU recovery story that I talked about, as well as restructuring, ST Engineering from the recovery of aerospace, but also globally, you're starting to see increased defense spending, and I think that will also benefit the stock going forward. Raffles Medical, I touched on earlier, as well as Venture, where they've got. We are looking at earnings recovering to pre-COVID levels going forward. Margins are very healthy, given the sort of differentiating capabilities that they have across all the domains that they're in, particularly in life sciences, as well as measurement. And I think they'll be one of the least affected in terms of a lot of the supply chain bottlenecks, given the strong inventory levels that they're holding. Now, so those are the sort of top 10 stocks that we're looking at as we go into the second half of this year. And I'm going to stop there, and we'll open up the floor for questions. So if you have any questions, just please put them on the Q&A box. Okay, so we have one question. Some companies have come out to say that they have locked rates for their loans. Typically, how long a period can loan rates be locked by? By when should we expect higher rates to be passed through and impact earnings? So typically, it depends on what is being financed. So I mean, a lot of the trade financing loans, they can't really be locked. I mean, and also they're shorter term, so 3 to 6 months. They tend to reprice higher almost immediately. So a lot of the trading companies will be impacted by that. But if you look at more balance sheet funded companies, you can potentially lock rates for 1 to 2 years. So I think if you do have this rate cycle going, you probably will see most companies re-looking at refinancing loans at higher rates more towards the second half of 2023 than currently. I think right now you are seeing quite a pickup in activity in terms of interest rates being moved towards fixed rates. Audience, if you have questions, please put them on the Q&A box. Hagbin, while we're waiting for questions, maybe let me just ask you, I mean, inflation is, one of the primary topics. What are you seeing in terms of when you think inflation will peak, and what are the sort of key indicators we should be looking for?
Yeah, so I guess we make a differentiation between core inflation and headline inflation. In Singapore, core inflation excludes private transport, the COE stuff and all that, as well as accommodation costs. I guess components that the MAS feels that they core inflation we.
Hagbin, you'll need to switch off your video.
All right. Yeah, so is this better?
Yeah.
So core inflation, we think will actually peak in the coming months. We actually think it will peak in the third quarter, which provides some breathing space. It will probably test 4%, but I think after that, it will start coming off simply because when you look at both food and energy prices, they're actually coming down. The UN Food Price Index has actually been falling now for 4 months, and energy prices are also have started to slip, partly on recession fears. Recessions are deflationary, so I think that will take off some of the price pressures. I think that's the positive part. We also see some of the transport costs coming off. We showed the chart on container freight rates. That's also coming off from their peaks quite a bit, as well as stuff like chip prices as well. So I think core inflation will probably peak, and probably that come October, MES may actually just maintain the current slight appreciation stance. Yeah, is our view.
Property stocks.
Got it. How do we see strong USD affecting businesses and manufacturers here? So, I think we actually did a survey across all our coverage stocks, and if you really look at a lot of the listed companies that are where they have USD costs, and most of them actually report in USD. So while you will see USD, when you translate that, so the translation impact is relatively minimal across a lot of the Singapore companies. Now, there's a few, some of the tech companies will probably be the most affected, given the fact that some of them reporting Sing dollars, and they do have the USD cost, so that will actually impact them. But on the flip side, a lot of their revenues are also in US dollars. So while there will be some impact, our last survey kind of showed that generally the overall impact should be not too high. Plantation stocks collapse on the sharp pullback of CPO prices. Any comments on CPO plantation stocks like Wilmar, Bumiputera, and First Resources? So yes, our plantation analyst is looking for prices to come off in the second half, particularly as some of the supply bottlenecks start to reduce, and a lot of the substitutes like soybean, rapeseed oil, and so on start to hit the market as well. So you should start to see some of that, some of the price pressures being impacted coming off. Now, how does that affect the plantation companies? So I think it'll really then come down to who can deliver volume. And within that, we like Bumiputera the most because they've got a fairly young plantation. So the overall volume growth side will be quite strong going forward, and most of their sales are domestic. So I think in terms of demand side as well as volume growth, Bumiputera should be relatively well placed. First Resources, not so much. Some of their forward sales have been still locked in at lower prices. So I think you might not see the same level of upside. So we have a hold on that stock. Now, Wilmar is interesting. Wilmar, has enjoyed over the last few quarters. If you look at their key sort of business lines, the main business line that has delivered has been the upstream plantations. That has done phenomenally well, given where higher prices are. But now, as prices start to come off, you will start to see that segment slowing down quite materially for the second half. Now, the question is whether the consumer segment, as well as the wholesale segment in the cooking oil, as well as the feed segment, will come in to support and offset some of that. And I think given China still remains effectively closed, and you still continue to see hog prices remaining quite competitive, the feed segment, in my view, will remain challenging for the second half. While the consumer side should start to see some improvements. Wilmar has been passing through some of the higher costs down the line. Obviously, a lot of this is food staples, so they can't pass through all the costs, but they have been passing through some costs. But you're also starting to see overall input costs coming off quite sharply. So that segment should start to see some improvements going forward. But for me, when I look at Wilmar, I think sort of the longer term strategy for a company like that, given particularly that its parts are valued more than the sum, the Arawana in YKA in China, Adani Wilmar in India, and the company actually has plans to continue to hive off some of the assets, particularly Indonesia, Vietnam, and Africa at some point as well. So this may, on a longer term basis, be a more delisting play within Singapore. Physical property prices have surged, but not the listed property shares. Will you comment on the anomaly? So I think part of this is possibly kind of pricing in the cooling measures and the higher interest rates that are expected. We are looking at mortgage rates potentially hitting 4% by the end of this year. These are rates that we haven't seen for more than a decade. So I think there is expectation that overall on the volume side things will slow down, and historically as well, property companies have traded below their NAVs as well. We have time for one last question, if there's any. Okay, if there's no more questions, anyway, we've reached time. So I want to thank the audience for joining today. Please, again, just want to remind you, take a minute and fill out this, scan this QR code and fill out some feedback for us as well. Thank you, everyone, and stay safe.